In this video, I'm going to interview someone very interesting who is actually doing something that I think will benefit a lot of people who are trying to protect their current assets or even trying to build wealth or start building wealth. And he talks about a concept that I truly believe in and am actually very fond of, and I think will help even expand your businesses or start your businesses at some point in the near future utilizing this concept. So if you're interested, make sure to stick around. What's going on, everyone? I hope you're all doing well. If you're new here, my name is Serge. Welcome to the channel. To all my reoccurring viewers, thank you so much for all the love and support that each and every single one of you have shown this channel. I greatly appreciate it. If you have not yet, feel free to check out the God Made podcast, Legion Assisted Living Academy, and Legion Assisted Living Advisors. And also, if you're interested in passively investing in residential assisted living, feel free to actually email me in the email down below. So without further ado, let's go ahead and jump into the topic of this video. All right, what's up, man? How's it going? I have a few questions for you, dude. How did you come about getting into this industry of financial asset protection, all this stuff? Tell me a little bit about that, kind of how you got into this field, and then we'll kind of get into your background as far
Yeah,
as kind of like your upbringing and all that kind of stuff.
yeah. Well, first of all, thanks for having me on, and I appreciate it. I got into this industry. It was kind of a little bit odd how I got into it. I got into it mostly from the insurance side. So I started off, most of my professional career started off when I was in college. I was doing my master's degree in business, and about a year into it, I needed to like get a job and work with it. I didn't want to just graduate with a degree and not have any work experience to go along with it. So I wanted to I was almost like, to put it out there, like desperate for work. I wanted to just do something that was professional, something that would look good on a resume. And I got a job at Allstate Insurance, and I was in sales. I was doing insurance sales, helping people with like auto insurance, homeowners, commercial insurance, other types of insurance. But then I actually really liked it. I actually got like hooked onto the career, got my licenses, and then after that, after I graduated, I then became a Medicare consultant. So I started working with companies like Blue Cross Blue Shield, Humana, Cigna Healthspring in the Chicagoland area. And I worked with people who were retiring, people who were like 65 years old, who worked for the city of Chicago, and they retired. And I was helping them transition from their employer plans to their own individually owned Medicare plans. So I was like their Medicare broker, in other words. I was helping them choose the right plans, choose the right networks, and all the things like that. And then during that time, one of my clients asked me if I could help him with life insurance. And he said, I'm interested in life insurance that has cash value in it. And then eventually the cash value would pay for the policy itself. And I had no idea what he was talking about when he was explaining this. But I just as in kind of basic terms, I was like, this sounds really good. It sounds like a very good idea and something not only that would help my client, but also would be able to help a lot of other people. So then I went to Amazon and I searched for books on life insurance just to like kind of learn more about cash value life insurance. And I
Yeah.
came across this book called The Bank on Yourself Revolution by Pamela Yellen. And the book talks about this concept, the bank on yourself concept, also known as the infinite banking concept. And then I started to read other books. I read Becoming Your Own Banker by Nelson Nash. And it was kind of just book after book. And I was like, this is actually a big deal now. You're helping people utilize the strategy, the infinite banking concept,
Mm-hmm.
of being able to recapture the interest you would otherwise pay other people, growing wealth, earning interest and dividends no matter what happens in the economy, connecting this with your business and other ventures that you could do. And then I started the company Financial Asset Protection, a financial services firm with our main focus of IBC or infinite banking. That's our main focus. I went through the Bank on Yourself training program for 8 weeks to become a Bank on Yourself professional. And this is what I do full time now. I still have a Medicare book of business and I still manage that, but this is what I do now full time. We run this company and help people with IBC. We help a lot of real estate investors, syndicators, a lot of business owners and full-time employees grow safe and predictable wealth regardless of market conditions.
That's awesome. So, yeah, man, that's a lot. That's awesome that you went from transitioning and then you saw the need, right? Just simply from one of your clients that you were doing insurance for. And I think this is so prevalent, especially in what I do, as far as like elderly, right? And people that
Mhm.
follow me on my channel and people that know what I do as far as assisted living, right? This benefits all the clients that I have, all the residents I have. And so, talk to me a little bit about kind of your upbringing. What was there always this like financial, because it sounds like you, like when you mentioned that you went from hearing about it but then actually doing research and then getting books on it, right? Were
Mhm.
you always like that growing up? Were you always kind of like, oh, this is something that is interesting, let me look into it more? Or were you not like that? Was that kind of something that was built?
yeah, I was always very curious. I always wanted to know how things worked, and I was also
Mhm.
really attracted to like solutions. So I liked the idea. As a young kid, I knew that money was really important. I grew up to an immigrant family in Chicago, in the southwest suburbs of Chicago, and money was definitely something that was a concern. And I always thought of it as something that was uh, either the opportunity for something greater or a problem to something. So it was either at a good time or at a bad time, money. And I knew, but beyond that, it was the way that people thought about money and how you obtain that money and how you keep it. That's
Yeah.
what really got me hooked. That's why I got my MBA. I really wanted to kind of jump in the world of business, but more so on the people side. I didn't really care about like large corporations or anything like that. I wanted to work with people individually and figure out like how can I help people with money problems. It was very general, a very general term, helping people with money problems. But that's why and then when this client told me about life insurance and cash value, it was kind of like my calling. It was like, hey, this is a chance right now
Mm.
to start doing more financial planning stuff than insurance. Insurance is a form of financial services. It's a part of financial planning, but it's not entirely financial planning. It's just a piece of it. And then I was like, this is the chance right now to start doing bigger things, uh, more related to what I actually want to do, problem solving, help people with money problems. So it was a nice blend. And out of every time I would, sell insurance in the past, I looked at it as like it was like another problem for people. Like people never want to talk about insurance. It's always something they want to kind of leave
Yeah.
until like they absolutely need it, and they always want it to be as minimal as possible. They want to spend the least amount of dollars, which is
Mhm.
common sense. People don't want to spend too much money on insurance. So I was always seen on the other side of the table as like this is the person that I have to be as cheap as possible with.
Oh,
But then
yeah.
after this, after this strategy came out, not came out, but after I found out about the strategy, it was like the opposite. And now clients are like, how much, what's the most I could add into this policy? How do I do the second policy? How do I do my third policy? So it kind of flipped the table now. I went from a
Yeah.
commodity to like a solution.
Yeah, and that's very interesting when you say that, right? Because there's always that phrase, right? You don't want to be the person who uh, you're constantly searching for people, right? You want
Hmm.
people to be coming to you for
Hmm.
solutions to their problems, right?
Hmm.
You always want to be the person where the cat comes to you because you got the food.
Hmm.
So you
Hmm.
always want to be. That's like such a interest. That's actually a really good point as far as when business goes. Is like, would you say that's I'm hitting that pretty head on? As far as business
Absolutely.
goes, right? Because you see that a lot with people starting their own businesses and everything. They try to figure out a way to make maybe a quick dollar, or
Hmm.
maybe they hear about someone that's making a quick dollar, but little do they know they put all this time and effort into making it look easy, right?
Hmm.
Um, but to get back to what you're saying as far as IBC, right? Because that is something I have been researching on for the last couple years. And for the people who don't know what that is, IBC is obviously infinite banking concept, right? And could you go more into what that is essentially in kind of layman's terms, and
Hmm.
then how would someone really be able to fully utilize the potential of IBC
Hmm.
or infinite banking concept?
Yeah, so in basic terms, it is life insurance, and there's different types of life insurance. So to kind of break it down, there's mostly two types of life insurance. There's term life insurance and whole life. So term is a set period of time. It has a start date and it has an end date. It's like renting. You only use it just for that time period. Like for example, if you get a 10-year term policy, it starts year one, it ends year 10, and then after it ends, that's it. There's nothing that you take from it. There's no cash value. There's no equity you take from it. The same way as renting. A whole life is the opposite of that. It's for your whole life. It has a start date, but not necessarily an end date. And then there's also cash value that builds up in it too. There's equity that's building up alongside it. So as you're paying into it, two things are happening with whole life insurance. You are buying the actual life insurance, and you have like a cash value component, like a savings account component to it. Now, IBC is focused on cash value life insurance, but it's not any whole life insurance from any company. There's about 1,200 insurance companies in the US that sell whole life insurance, but this is pertaining to high early cash value whole life insurance used for cash purposes. It's not used as if it's definitely a really good form of life insurance, but that's not the overall intent of it. It's not just a life insurance form. It's more of recapturing the dollars you would otherwise spend out. You would recapture those to keep in your own pocket. What that means is, let's say, for example, you're a business owner, right? And in business, a lot of business owners want to keep scaling up and reinvesting their dollars back into their business. And then that's also obviously a really good way to scale your business, but also that's a problem too, in the sense that you might lack liquidity when you do that. When you keep reinvesting back in your business, what happens when you need to take money out for an emergency, or take money out for another business opportunity, or something else comes along the way where you just need the capital, you need access to it? This is one example of what IBC could do, is that you have the ability to fund the whole life policy and then borrow against it, use for your business or for whatever you want. There's no restrictions on what you could use the money for. You could use it for whatever you want. So you're funding this whole life policy, borrowing against it, using it, and then being able to pay yourself back and putting the money back into this orbit, this financial orbit that you own. So now what's happening is you're doing two things. You're growing your business or your real estate empire or your residential assisted living business, and you are growing your whole life policy at the same time with the same dollars over and over again, kind of like recycled in within your financial orbit. So you have the ability to do more than one thing. That's just one example of using it. Another example could be, let's say, for example, somebody's a W-2 employee. They have a job and they want to save for the next 30 years. This could also be used for that. You could save into a whole life policy, in a cash value whole life policy for 30 years. And then at year 30, let's say, for example, you're 65 years old. Now you can sit back and then have this almost like a pension-like account where you're getting like a monthly income stream from the actual whole life policy on a guaranteed and on a tax favored basis. So I'll kind of just stop talking now and listen for any questions before I keep going.
Yeah. So it's essentially, from what I'm understanding, is you treat it as your own bank account, right?
Mm-hmm.
As your own loan that you would like, let's say traditionally I would want to go scale my business, or even just get a personal loan because I have something come up last minute, right? That I
Mm-hmm.
need. Instead of going to the bank and them charging me, let's say 5% interest on the personal loan that I get out, I instead call my whole life insurance company, say, hey, I want to borrow against my whole life insurance. But in order for IBC to work, right, and this is where I think a lot of people will need to understand this, in order for this concept to work, is you have to treat it like a loan, right? Because you're going to
Mm-hmm.
have to want to repay yourself back at that same market interest rate that you normally would have gotten at a bank. So let's say I pull 50,000 at 5% against my whole life insurance, because that's what the traditional bank would have given me. I now pay myself back, right?
Mm-hmm.
And so that will continue growing over the period of time that I have the policy, which is obviously my whole life.
Mm-hmm.
So another question I have for you, for the audience, and for other people listening is, at what rate does this whole life insurance policy grow at, right? What's that growth rate look like? Because clearly you're saying, okay, you treat it like a savings account. It's going to grow over the next 30, 40, 50 years, however long you're alive for, that cash value at least.
Mm-hmm.
What does that look like as far as growth rate?
Mm-hmm. Yeah, and just to be clear, both the cash value and the life insurance amounts are growing every single year to
Okay.
outpace inflation and to keep up with the standard of living. So let's say, for example, on average, the way we set up the policies is that they have a minimum like guaranteed rate, which is 4% compound interest over the life of the policy. So guaranteed, the policy is already built in to give you 4% every year. And then plus you get
Okay.
dividends on top of that. The dividends are based off of the performance of the insurance company itself and not the performance of the market or any other external factors. It's just the insurance company itself.
Okay.
And with IBC, one of the parts of it is that you're a mutual owner of the insurance company that you're with. So, for
Okay.
example, one of our companies that we use is Foresters Financial. They're a mutually owned insurance company. So when you buy a whole life policy with Foresters Financial, you've become almost like you've become a mutual owner of Foresters Financial. So you share in the profits with them. So at the end of the year, once they pay out all their expenses, whatever's left, they distribute that amongst all the policy owners, obviously in proportional to how much you've paid into it. So somebody who has $1 million a year policy versus somebody who has $1,000 a year policy, the person who has $1 million, who's paying $1 million a year, is going to get a lot more dividends than the person who's paying $1,000 a year. Just like the same way how if you had more shares of a company, you would get more dividends at the end of the year.
Okay.
That's one of the objectives of IBC, is you're a mutual owner of an insurance company. And once you borrow the money from the company, the key is that when you borrow is that you have guaranteed liquidity. So there's a guarantee, so that you never have to qualify for the loan. And also it's a non-recourse loan. So what that means is the policy itself is self-collateralized. There's no other collateral but the policy. This means that you never have to put up your credit. You never have to put up other collateral to get that loan out. It's just the policy itself that's collateralized. And then you pay that back on your own terms. So it's recommended to pay it back. You never want to just borrow and not pay it back, because that's going to interrupt the death benefit in the later years if you pass away, whatever is the outstanding loan, they will deduct it. It's
Okay.
best to pay it back so that way you can keep borrowing over and over again.
Okay. That makes sense. Yeah. It's definitely a really solid way to. One question I did have
Mhm.
was, can you talk about non-mech?
Mhm.
Meaning, is it? Can you explain that for
Mhm.
people who don't know what that is? I know what that is, but I'm
Yeah.
asking for the audience because, right at the end of the day, as business owners, as people, we try to limit our tax liability as much as possible, if at all of it, right?
Mhm.
Legally,
Yeah,
is
of
there a way
course.
to do that with IBC?
Absolutely. That's one of the another huge advantage of IBC is the tax advantages. So I'll kind of break it down. There's MEC and non-MEC. And so MEC stands for Modified Endowment Contract. If you have a policy that's a MEC policy, that means it's a taxable contract. The same way how an IRA or 401k is taxable, that's that a life insurance policy could be taxable in that way. You can't access it until you're 59 and a half. If you do, there's a 10% penalty. So that's a MEC policy. About 95% of the situation, we do non-MEC policies. We're doing non-modified endowment contracts. In other words, tax-free retirement or tax-favored accounts. That's one of the objectives of what we do. Sometimes, though, we intentionally do back policies. Like, for example, if somebody puts in like a lump sum premium, a one-time premium into a whole life policy, like
Hmm.
$100,000 one time goes into it, that's a MEC policy. It's a modified endowment contract because it does not meet the IRS standards of a life insurance policy over something called the 7-pay test. So because you're not paying into it on an average of 7 years, it's a modified endowment contract now. And then now the gains of the policy, when you take it out, are taxable. And you have to wait until you're 59 and a half to access it. If you don't, then you'll be taxed ordinary income plus a 10% tax penalty on the withdrawals of the gains before
Okay.
59 and a half. That's a MEC policy. Non-MEC is tax deferred growth. And then when you take the money out, it comes out tax free because you've already paid taxes on it. And it's a non-modified endowment contract or a non-MEC policy. And we try to stay on the non-MEC side because that's a huge
Yeah.
advantage of IBC is being on that tax-free side, is being able to use tax-free dollars over and over again and being able to grow it at a tax-deferred basis.
Okay. Question I do have for you.
Mhm.
So, because since we're talking about taxes, let's say I pull out 50,000, right? Let's say 10
Mhm.
years down the road, I pull 50,000 against it. Is that taxed at my current tax bracket, income tax bracket that I'm at, or no?
So it depends.
Does the non-mech still apply to it or no?
So it depends on the way the policy was structured to begin with.
Okay.
If you started the policy as a non-MEC option, like for example, let's say you put in $10,000 per year, and then 10 years later, your cash value is like, let's just say rough numbers, $120,000 in cash value. Yeah, that's a non-MEC policy. You could borrow up to 90% of that. You could withdraw any amount you want on a tax-free side.
Okay. Okay. So 90% of that you can borrow against.
Mhm.
Okay. And then it won't be taxed.
Yeah, and typically loans are usually never taxed. The loan part is it's where you withdraw and take the money out. That's when there could be taxes due.
Okay, I see what you're saying. And then for like on a business side, is there any way to write that off, right? Like let's say I'm paying back into the policy at that
Mhm.
5%. Could I say when I go to do my tax returns, my business, let's say, is paying that interest back into the
Mhm.
policy, right? Could that be considered a write off or no?
It's possible, yeah. It's something that you want to definitely check out with your certified public account, your CPA.
Okay.
It definitely, but it's possible. Yeah, you can write
It's
off the taxes if it's for business purposes. If you used the loan for business purposes.
Okay, that makes sense. Yeah, so that's another benefit to it, right?
Mhm.
It's like, okay, you don't get taxed when you pull it out, but then you could also utilize it potentially, right? We advise
Yeah.
everybody to consult with their CPA and their professional advisors to make sure. But that, yeah, see, so that's very interesting. You know, that's for anybody that's looking to grow a business, or yeah, you could use it for anything, even if it's for personal reasons. But then if that's different, you won't use that as a write off
Mhm.
potentially. So another thing I wanted to ask you about is how do you help real estate investors? Because this is something I do, right? I invest in real estate. People also that are watching the channel and everything listening. How does this ultimately help real estate investors? What do you see a lot of real estate investors that you work with? What do they end up doing? What do they not do? Could you tell us a little bit about that?
Mhm. So a lot of people have different objectives with IBC because there's so many different things you could do with it. But one thing that I do see that's common is that eventually real estate investors want to cut out banks and hard money lenders and private money lenders So what this means is, let's say, for example, somebody's in real estate right now, right? They're buying, they're doing flips, they're renting out properties. They're constantly going to a bank and they're filling out long mortgage documents. They're waiting 30 to 60 days to get loan approvals. They're also going, and then the shortcut to that is going to hard money or private money, where you can get funding in like 3 to 5 business days, but typically at like 3 times the average interest rate. Like you're paying like 15% interest sometimes, and usually higher fees than a bank, but it's faster to get loans.
Yeah.
So what a lot of real estate investors do is they build out these policies, IBC policies, with the hopes of one day soon cutting out banks and hard money lenders, where they can go to themselves when they need a loan. For example, they come across a property, it's $80,000 to buy the property. They need funding in 3 business days. They're cash buyers. They go to the insurance company, they fill out a form, they request a loan for that amount, and then now they become like their own mortgage. They pay it back on monthly terms or whenever they want. But the overall biggest objective I've seen real estate investors do is become their own source of financing. They structure it so they never have to qualify for a loan. The insurance loan, the document is like 3 questions long. It's what's their policy number, how much do you want, and then where do you want it? Do you want it as a check, or do you want it ACH deposit into an account? It's
Wow.
very quick, and it's obviously a dream come true for not only real estate investors, for also business owners. Because one of the biggest problems with getting funding is going through that strict process of qualifying for a loan and relying on a bank too. Because a lot of times you might be in a good situation to be bankable, where you're lendable, but the bank might not be in a situation to loan out because there might be we're focusing on different projects, or you never know what could be happening on the back end.
Yeah.
But with IBC, you put yourself in a position where you never have to rely on somebody else telling you that how much money you can get, how much you can qualify for.
Right. And the thing is, another question I do have for you is it because a lot of people could make the argument like, okay, if on, oh, I want to ask you this. So
Mhm,
like the average annual rate
mhm.
that the insurance company, what do you see that usually on average when you guys are growing the portfolio and then like once dividends are paid out and everything? You said the bottom
Yeah.
guaranteed is 4%, but then
Mhm.
once dividends and everything are paid out, what does that look like?
Yeah, good question. We see on average between 5 and 6% every year on a long-term spread. But one thing that's
Okay.
really important to know about the rate of return is that it's not, because a lot of times people will be like, okay, I can get, potentially 5% in my whole life policy, or I can go out and do real estate and get 8% or 10%.
Which leads to my next question. Yeah.
It's not meant to replace the other one. It's rather it's meant to be integrated, where it's you do the whole life policy, you borrow from that, and then
Mhm.
you invest in real estate or syndication deals or whatever you want to do with it. But it's meant to take control of those dollars and then simply replace a savings account, because there's more benefits. Like we can get into more on asset protection. We already talked about the tax benefits. We
Yeah.
talked about the hedge against market risk. So it's replacing. It's a savings advantage, a saving strategy. It's not so much of an investment strategy, but it could be used alongside other investments for sure.
Absolutely. And to your point, because instead of just putting your money into a savings account, right? Like it's just a
Mhm.
traditional that's paying like max maybe 0.8% or like
Yeah,
a percent, right?
yeah.
On the money that you're saving, right? And with inflation, that money is losing value.
Hmm.
So for people who are like, well, I could just save up my money in a savings account and then just obviously you utilize it when I need it.
Hmm.
But what you're saying is like, well, why not have a whole life insurance policy, which when you pass away, unfortunately, when that time comes, because it's coming
Hmm.
for everybody.
Hmm.
But when that time comes, not only do you have a policy in place, but during that period, you're growing this cash value that you can be utilizing at any given point at a way higher interest rate,
Hmm.
right?
Hmm.
So like that is what's intriguing about this whole concept is like, okay, well, instead of just throwing $10,000, it's good to have like an emergency fund, just
Hmm.
kind of some petty cash set aside, right? That you can just access any day.
Hmm.
But this is more of like a long-term play as well, investing into an IBC. Like for people who just continue to save, because there's a lot of people like that because they're worried, they just like seeing that number in their bank account for
Hmm.
whatever reason. There's a lot of weird reasons why people just do it, right?
Hmm.
But doing this essentially is a lot more beneficial because you can always access it. Like you said, it's so much easier to access than trying to go and get a loan or uh, whatever the reason being, right? So you can hedge it up
Hmm.
against everything else instead of just having a savings account that you'll just draw out of whenever you need it. You could utilize it and always be paying back into it. So instead of just putting $300 or $1,000 into your savings account every month, because if you're smart, that's what you do, right? you just automatically keep investing it or putting it somewhere. But
Hmm.
instead of just putting it into a traditional savings account, it's like you can just start now automating that account with your whole life insurance policy. And so, yeah, for people who are just thinking, well, okay, how could this be beneficial? Well, think about all the tax advantages you're getting, the rate of return that you're getting on your money compared to just a traditional bank account. And like you said, it's not to replace anything else you're investing
Hmm.
in. You can still invest in other things, right? You can still, but like budget that in on a monthly basis or on a yearly basis, however you do it, and just continue using this vehicle of wealth to help you fund all these other things, right? Whatever else you're doing. And a question I did
Hmm.
have leading into this, another question I have is, are there are a certain amount of policies that I can pull out, whether it be like for my personal self or for family? Is there a limit on that, or how young or how old they can be? What's the criteria there?
So typically, there's no limit per se on the amount of policies you have. What they'll do is you can get up to 25 times your annual salary in life insurance. So this means, for example, if you make $100,000 a year, you can get up to $2.5 million in death benefit life insurance, not the cash value, but the death benefit. And that
Hmm.
also means that it could be spread out within a bunch of companies. So you can get, 5 different companies as long as they equal $2.5 million at that given time. Of course,
Okay.
you can always circle back and then get more and more policies as you're making more money. That's one rule. So it's usually about 25 times your annual salary. And the second rule is you can get up to 1 times your net worth. So for example, if you inherited like $5 million in a trust or in cash, you can get up to $5 million in life insurance to cover that if you wanted to. So the restrictions are based mostly off of your income and your net worth. One thing
Okay.
we always do with a lot of clients is we do like 6-month reviews with clients to see if they're making more money, and then they circle back and they do second, third, fourth policies. Like I myself, I started off with this concept 3 years ago. I did my first policy. I recently did a second policy. I did one for my wife, and then we're on the rate right now, hopefully, of doing like one new policy every other year each. So this way we can have, our goal is to have like a few $1 million in retirement, tax free and asset protected, to protect from creditors and other outside risks by that time, by utilizing it slowly and gradually building up these policies.
Okay. And let's say for like the parents out there,
Mhm.
they got a young kid or they're about to have a kid,
Mhm.
are they able to pull a policy out on them?
Yeah, absolutely. We've done for children as young as newborns, and what they'll do is, for example, the parents will get a life insurance policy on their kids, but it's mostly for college savings. So what they'll do is
Okay.
they'll buy the policy, put in like $200 or $300 every single month, the same way how you would put in a 529 college savings plan or other college savings fund. You would pay into like $200 or $300 per month, and as you're doing so, by the time they're 18, they'd be able to completely finance their college education. They would have like $80,000 in cash value by that time through compound interest and compound growth. They would have like $80,000. And then now, instead of going to Sally Mae or the Department of Education or other private banks to finance their college, they can go to the family account, the account that was set up for the children, borrow from that, pay it back on their own terms. They get the tax advantages too with that of the growth, the tax-free growth, and they don't have to use it for college. So a lot of
Yep.
times, some people don't, not everybody goes to college. What if somebody wants to start their own business when they're 22 or 23 years old? They can go to that policy that was set up for them when they were kids and then access that. Instead of going out to a bank and borrowing money from the bank, they can go to that policy and then borrow against that to use for whatever it is they want to use.
Yeah. And the 529, that's kind of the downside to it, right? If it's not used for college
Hmm.
and you pull it out for something else, you get taxed quite a bit on it.
Hmm.
And sometimes depending on who you do it with, sometimes you can't even access it. It has to be transferred to another person who's going to utilize it specifically for college, right? Or education. So
Hmm.
yeah, see, that's something I find very intriguing about the IBC concept and the whole life insurance policy is that, there's really no age limit on it.
Hmm.
Usually with like a Roth IRA or a 401k, there's age limits on that depending on who you go with. But usually you can't get it until you're at least 18 years old in most
Hmm.
cases and 21 sometimes. So yeah, that's what's so intriguing about this, for parents who are out there thinking, or future parents, it's like maybe utilize this concept to be able to either get them a car,
Hmm.
when they're 16, right? and then be able to use that as a way for them to pay back, like have them go get a job and teach them discipline and pay you back. But little do they know that they're paying themselves back, right? You kind of treat it as this like really cool discipline vehicle as well for your kids, and
Absolutely.
they wouldn't have to worry, or at least as a parent, that's always a concern, is like, how am I going to pay for my kids' college, or how am I going to get them their first car,
Hmm.
or even medical bills, right? Something
Hmm.
comes up. It's like that you can always have access to this as well.
Hmm.
So yeah, man, I am absolutely in love with the idea of IBC for sure. How do you think about people who what are some of the common misconceptions about whole life insurance policies and IBC? What are some of the things that people come to you about and are a bit skeptical? For the people that are still kind of on the fence about this, or they're listening to this and they're like, it all sounds really good, but I don't know. What are some of those misconceptions that you realized or noticed with IBC?
Yeah, misconception number one is that all whole life insurance policies are the same, and that's not true. There's different types of whole life insurance. Like for example, there's stock owned insurance companies and then mutually owned insurance companies. So a stock owned insurance company would give their dividends back to the shareholders, whereas mutually owned insurance companies give their dividends back to the policy owners, the customers. So that's
Mm.
one huge difference right there. That knocks out probably 70% of all insurance companies. Is that
Wow.
yeah, that's a huge misconception there. And then the other is that the way the policy is structured. So not all whole life policies are just 100% whole life insurance. There's a strategic way that they're structured, the way that they're built out and designed. So for example, we might do a policy where it's 50% life insurance and then the other 50% is going towards the cash value, or something called the paid up additions rider. So it's a special way of building out the policy, so that way it builds up more cash over time. Like people like, for example, Dave Ramsey and Susie Orman talk about whole life insurance and how it's a very negative thing. It's a bad thing. It's a bad investment.
Mhm.
And they could be right, because there are types of whole life insurance out there that could be a terrible investment with very little cash value. They're super expensive, but we design it a different way. We design it more in the infinite banking concept on the IBC way, which is high cash value and high growth and high liquidity too. So it's meant to free up cash, not so much be an expensive insurance policy. Another misconception people have is that they compare it directly to term policy. Even though they're both life insurance forms, they both have completely different functions. Term insurance is strictly life insurance if you died prematurely. That's the only objective of it. There's nothing else you could do with term policy. And it's not a bad thing. It's not necessarily a bad thing, but that's just the way it is. It's like, for example, if somebody's 40 years old and they want to just be able to protect all their assets in case something happens to them, yeah, we would do a $2 million term life policy for super cheap, maybe like $30 or $40 a month, depending on their health and their age and where they live. Well, like very cheap. But then when it comes to whole life insurance, people automatically compare term to whole life. Like instead of doing whole, I could just do term. But again, two different functions. It's apples and oranges. They each have their own avenues and their own ways and their own methods. There are a lot of times we do both term and whole life insurance. The whole life insurance for the cash use, the interest, recouping that interest, being able to borrow against it, the asset protection behind it. And the term is just strictly for life insurance only. So another misconception to reiterate that is that different functions and different and for different people.
Okay. Yeah. See, that clarifies a lot for even myself, right?
Mm-hmm.
Like I have a term insurance,
Mm-hmm.
but you can always have both,
Yeah,
right? And I think that's another misconception. It's
yeah.
like people just kind of stick with one thing, and it's
Mm-hmm.
like I'm gonna just stick with that and hope for the best.
Mm-hmm.
And if it runs out, it runs out.
Mm-hmm.
And it's always good to have all your bases covered, right?
Mm-hmm.
It's like, okay, I'll do term, but I'll also do whole, because if my term is for 20, 25 years and I
Mm-hmm.
live past that, by that time, and I know you and I have talked about this, by that time at 25, you may not even qualify
Mm-hmm.
again, right? You may have some health issues that come up during that 25-year period that either may decrease the amount that you can actually pull a policy out on,
Mm-hmm.
or it may cost you more,
Mm-hmm.
right? And so with whole life, you set the rate of what the policy is going to be. Does it stay that rate, or do you guys do like a annual or like a 5-year renewal, or what does that look like?
Mm-hmm. So we set up the policy so that way it's flexible. So like, for example, let's say you want to do $10,000 a year. The way the policy will be built up is that 50% of that will be like base life insurance. So 5,000 every year has to go for example, for 20 years. Every year you have to make up $5,000 for the next 20 years. And then you have the option of adding up to $10,000 every single year into the policy in addition to the 5,000. And of course, the additional money that goes into it goes directly into the cash value to build it up. So in other words, let's say, for example, you're in sales and one year you have it really good, you just fund a policy $10,000. The second year sales are really low, you just have to meet the minimum of 5,000. The third year, so let's just say sales are really good now, you fund the 10,000, then you can even go back and fill in that previous 5,000 that you missed to put in to make it an even $10,000 per year. So we set up the policies this way, so that way you're not stuck with like a 20-year bill that you have to maintain, and if you don't maintain it, the policy will cancel. It's meant to improve your financial situation and help you financially, not so much of getting in the way. Another thing you could even do is, let's say, for example, the same example, 10,000 every year. Let's say year 5, you can't even make up the minimum 5,000. You can go back and borrow from the previous years, from the cash value that was built up from the previous years, to pay in for the following years. So a lot of different creative things we could do to keep the policy living, to keep it growing, to keep it earning interest and dividends over the years.
And say you don't meet the minimum for
Mhm.
whatever reason, right? Let's say you don't have enough cash value. Let's say it's like year 2, year 3, so you haven't
Mhm.
really built up enough cash value and you can't meet that minimum. What happens there?
So a couple of things would probably happen is, one, just like anything else, it would cancel. The policy would cancel, and then you would probably just get whatever cash value is remaining if you had any cash value back.
Mhm.
Another thing too we could do is, this is something you probably do later on, where it's like after year 10 you could probably do this. Is that it's something called reduce paid up. It's where you change the policy. For example, if you say I'm going to do a policy for 20 years, and then let's just say year 8, year 9, it's getting too expensive, you could reduce, pay it up. So that way, instead of paying it for 20 years, you pay it down to like 9 years or 10 years. You reduce the life of the policy. But when you do that, that's an option. But when you do that, it reduces the future death benefit, because obviously you're paying less into it. And then of course it reduces the cash value for the remaining years. So that's another thing you could do, is cancel the policy or reduce paid up to shorten the period of time of the payments of the policy.
Okay, yeah. And so if let's say, because it happens, man, life
Mhm.
happens, things happen, right? And so like just to cover all questions, so you're saying if the policy gets canceled,
Mhm.
that cash value, is it going to, it's not going to be the same amount that you've paid in, right? Will you lose money there? Does that make sense? I don't know if that question
Yeah.
is making sense.
Yeah. In the first few years, if you do this in the first few years, you will probably lose money, because the amount of premiums you're putting into it won't meet the cash value yet. So for example, you put in $10,000 year 1, your cash value might be 6,000. Year 2, you put in another 10,000, your cash value now is like 13,000 or 14,000. Year 3, you put in another 10,000, now it's up to like 22 or $23,000. So year 3, if you walk away, you only walk away with $23,000. So you took a $7,000 hit on the policy. But one of the things we do with clients is we make sure that this is a long-term strategy. This is something they want to do for the next 10 or 20 or 30 years, not something they want to do for a few years.
Right.
There's different types of things that you could do with your, if you're just solely focused on the next 1 or 2 years, there's different solutions for that. But if it's using IBC, it's meant for long-term, and it's meant for changing the way you spend dollars, not so much of locking up money. So
Mhm.
to answer your question, if you were to walk away from the policy in the first couple of years, you'll probably take a hit in comparison to the amount of premiums you put in versus how much your cash value is.
Yeah. See, and that's a really good answer, because I want people to understand the risk, because there's some risk,
Mhm.
like if that's what your mindset is going into it,
Mhm.
is thinking, like you said, what are your goals? What are
Mhm.
you trying to do with this? And this is more
Mhm.
of a long-term play, not something that you just kind of throw some, like a CD or something, right?
Yeah,
You just
yeah,
throw money and then hoping to get it out in like a year or two.
yeah,
Yeah,
exactly. Mhm.
that's a very, yeah, I'm happy you answer that, and hopefully that kind of clarifies some people's thoughts and questions as well. So, question I have, just to kind of sum up everything,
Mhm.
is what are some of your favorite books currently right now that you're reading? What are some of the things that you recommend for people to research on this topic more?
Mhm.
You mentioned a few books earlier, but if you can kind of reintroduce those books and kind of what you're
Yeah.
currently reading.
Yeah, so one book, The Bank on Yourself Revolution by Pamela Yellen. It
Okay.
talks about the bank on yourself strategy, and then Becoming Your Own Banker by Nelson Nash.
Okay.
That book also talks about, Nelson Nash invented IBC, so that book gives you kind of like the grandfather approach to this whole concept. It gives you like the base of it.
Okay.
And then just in general in business, I love reading books. Like for example, this one book called Mindset by Carol Dweck. It's a phenomenal book. If you're an entrepreneur, you want to be an entrepreneur, check out that book. It's called Mindset. It talks
Okay.
about the differences between a fixed mindset and growth mindset. And then I'm reading another book right now, The Richest Man in Babylon. Talks about
Yeah.
saving. Yeah, it's a classic.
Yeah.
Yeah.
You were, I was just listening to a podcast and by the way, he does have a podcast that you guys can all check it out. What is it called? What's your
Uh,
podcast called?
Thinking Like a Bank.
Thinking Like a Bank. And how many episodes you currently have right now?
So right now we have 6 live, and then we have about, I think, 7 in queue, which you're one of them. Yours should be up in the next few weeks.
Yeah, so you guys should all go check that out. I talk a bit about everything I'm doing as well,
Mm-hmm.
but definitely check out his podcast. It's really great. The reason why I'm mentioning his podcast, which he was going to mention at the end anyways, is because he had someone on there who mentioned this book that you just mentioned right now, The Richest Man
Mm-hmm.
in Babylon. So I'll definitely have to get that for myself too, because
Mm-hmm.
it sounds like it's a really solid one. Are you liking it so far?
Yeah, yeah. The only problem with it is like it's written in Old English, so it's just kind of hard to read. Not hard, but it's just not easy to read Old English for me at least. But yeah, it's a really good. It gets you thinking a lot about like money and like just live the way money, like a lot of misconceptions about money, like good debt versus bad debt, growing wealth no matter what, predictable wealth. But yeah, definitely.
Yeah, what are your thoughts on that, on good debt and bad debt?
Oh yeah, there's a big difference between good debt and bad debt. Not all debt is the same. Like for example, an example of good debt would be a mortgage in the home you live in. For example, that's a good debt because it's a low cost of capital. You're getting interest, especially with interest rates today. It's like what less than 3%.
Yeah, you're
So
almost
it's
getting it for
yeah,
free.
exactly. It's a low
Wow.
cost of capital, and then you could take that money actually, and then you go use that in business or whatever, and then that'll be a better source of financing for you than going out and getting another loan. So this is thinking like a bank. Banks actually don't have any, for the most part, don't have any money. They borrow money from either through lender financing through other banks. They raise capital through investors, and those investors own shares of the bank. And then they get their money from depositors. So when you go to the bank and you deposit $1,000, you're actually loaning to the bank. You're loaning the money for them to go out and use that money. So banks are just kind of middlemen that have billions of dollars from other people, from investors, other banks, depositors, and then they use that to finance mortgages, credit cards, auto loans, and they charge 5 or 6 times the amount of interest they're getting. And they keep the difference between that. So they'll buy at 3% or 4%, and then turn around and sell that at 10% or 12%, and they keep the difference between that. This is thinking like a bank, and it's not. The strategy is not exclusive to banks. Anybody could use this. So we talk about this with whole life policies. You could borrow from your policy at 5%. You could actually become. A lot of our clients are hard money lenders, so they borrow at 5% from the policy, turn around and loan it out at 15%. And there's a lot of different things you could do. So good debt helps you leverage good sources of capital. And then bad debt obviously is the other side of that. This is where you're paying high interest and you're not able to make money on that money. Like
Yeah.
credit cards for the most part are bad debt. You're going to pay 12%, 13% interest on that money compounded every single month. It's a trap for bankruptcy. It's a trap for debt. That's one form of bad debt.
Yeah, like consumer debt,
Yeah.
things that are just appreciating, things that are taking money out of your pocket and not putting in it, right? It's burning a hole in your pocket. Yeah,
Exactly.
I absolutely love that, dude. Tell me a little bit about what you got going on now and kind of what the future looks like for you.
Yeah, it's a good question. Yeah. So right now we just have the company Financial Asset Protection and the podcast Thinking Like a Bank. We definitely want to expand through. I want to take over another insurance agency with clients and like a financial services firm already that's built out and kind of take it over. That's one avenue we want to go down. And then we want to kind of just expand with the podcast, get more episodes up, and overall grow. How be able to help more people and contribute to people. I want to also create maybe in the next 5 years, create a not-for-profit that gives out completely 100% free education, free credit counseling to people across the whole
Wow.
country on a virtual basis. You can just call in and get free financial counseling. That's like my long-term goal.
Dang, listen to that, guys. You always got to be willing to give back. I think
Mm-hmm.
that's something that a lot of people just overlook or just don't think about is giving back, man. Giving back is so important to just living a fulfilled life. And it's not really even just about money, right? It could be
Mm-hmm.
about education or setting up a non-for-profit or just giving back, man. And I love everything you're doing right now. I'm absolutely excited for everybody to continue looking into you and checking you out. And yeah, feel free to go to, I'll put your
Mm-hmm.
website and everything for people to reach out to you if they have any questions or they're thinking of even getting a policy through you.
Mm-hmm.
I think that would be awesome. I'm really happy and I'm excited to continue working with you, man, and seeing where the future takes you. And yeah, man, I'm excited for it.
Yeah, thank you very much, Serge, for having me on the show. Actually, and if listeners go out and they go to our website and schedule an appointment, I'll actually give them a free copy of whichever book they want. If they want Becoming Your Own Banker or Bank on Yourself Revolution or The Richest Man in Babylon, I'll send them a free copy of that via Kindle if they reach out, just as a thank you for having me on the show.
Oh, for sure. Yeah, guys, just make sure. Yeah, just let him know that I sent you guys over, that you guys came from the YouTube channel or the
Mhm.
podcast or whatever. And yeah, he'll send you over a free book. I mean, hey, never hurts to have another book, right, in your
Of
shelves and under your belt, right? So
course.
awesome, guys. Well, thank you so much. If you haven't, please subscribe. Go check out his podcast, Thinking Like a Bank. It's on all platforms, right? It's on
Yes,
all streaming
correct.
platforms. Do you have a YouTube channel for your podcast or no?
I do. It's just the episodes only, and I hopefully I want to catch up to you and have it more like dynamic and more
Mhm.
more things going on in it.
Oh, for sure. Yeah, man. You let me know if you ever need any help with that. I'd be
Thanks.
willing to do anything I can to help you out. So, yeah, guys, go check them out. Make sure to hit me a like button if you're watching this on YouTube and subscribe. And I'll put everything in the description, not only of the podcast, but even of the video. And you guys can go check them out. So, thank you, dude. I really appreciate you coming on and taking time out of your day. And yeah, I'm looking forward to working with you in the future.
Thanks, Serge. Appreciate it.
Awesome. Thanks, guys.